I'm Kevin Duggan. I'm with Games for Change. I'm the Director of Development. And so these sessions, as I say, have really rewarding. And it's been interesting this year in particular. We've had the opportunity to have these sort of hear directly from folks from the venture community in particular, as well as traditional not-for-profit funders and government agencies, folks like that. So it's been a really great opportunity. So just quickly, the format of this session is, it's short, it's about half hour. We try and keep it very interactive with a lot of time for questions. I will ask folks to hold your questions till after the presentation and then post it to the chat field. And we'll try and get through as many of those as we possibly can. Just a couple of quick housekeeping notes. The presentation, you can double click on any window in the hop-in window and enlarge it. So when the presentation is on, feel free to double click on that to make it a little more readable. And if we don't get to your question, or if you want to follow up after the session with Archie or Michael, Archie's posted his email address, which is pinned at the top of the chat field, and encourage you to follow up with them after the session. So I think that's basically it. So without further ado, let me introduce these guys from the Makers Fund. And so we have with us today Archie Stonehill, who is an investor at Makers Fund. And I'm going to read your bio real quick. Archie focuses on finding and supporting founders from across Europe, a truly passionate gamer, which makes him a good fit with the Games for Change community. With a diverse set of gaming interests, he enjoys working closely with founders on product and go-to-market strategies. And Michael Cheung, who's a general partner, and actually his bio is really more about Makers Fund, so I'll just read that real quick. So Makers Fund is a venture capital fund dedicated to furthering the growth and innovation in the global interactive entertainment industry. Michael, you want to tell us anything else about yourself before we get started, in terms of your role there in particular?
Yeah, sure. No, so I basically help lead all our investments around Europe. My background, actually, I was a data scientist, mainly for entertainment, media, and gaming companies. And I think we started this really because there just wasn't enough funding in the industry. So I've been very fortunate to do this for the last 3 years.
Great. And you're calling in from where?
Right now, I'm actually in Singapore.
Right.
So I think we're crossing all 3 major continents right now.
Right. And Archie, you're in London, right?
Yeah, that's right. Despite my background, I'm actually in London.
Yeah. All right, great. Well, thanks again so much for being with us, you guys. So I'm going to turn it over to you. You can do your presentation, and then when that's over, we'll jump back on and have a conversation.
Great. So I should be sharing my screen now. Hopefully you can all see it. This is kind of very briefly what we'll cover. We're going to go over who Makers Fund is, what venture capital is, why and how to get VC funding, and then what VCs look for. And then we'll have time at the end for a Q&A. Michael did a quick introduction of himself. We both cover Europe. Before joining Makers Fund, I was an advisor to investors, mostly a much later stage of investing called private equity. I advised private equity companies on the games industry. Michael, I don't know if you want to do any more of an introduction for yourself here.
Yeah, and we also work with companies in and around the rest of the world, so North America and Asia Pacific. It's just that we mentioned Europe specifically just because that's where we spend the most of our personal time, but we also have team members who focus on the other continents as well.
Great. So Michael and I both work for Makers Fund. This is kind of a summary of what Makers Fund does. We'll try and kind of explain each of these terms as we go through the presentation. But basically, we're investors, and we invest exclusively in interactive entertainment. Interactive entertainment, as we understand it, is kind of games and everything that relates to games in any way. So we do invest in games content companies, But we also invest in other things that touch the games universe. So development tools, technologies, game development engines, that kind of thing, as well as things that are related to games culture. So video game, clip sharing websites, influencer-led business models. We really have quite an expansive view of what we consider interactive entertainment, but games is really at the heart of it. We've been around since around 2017. We've made 50 investments, or over 50 investments. And as Michael said, we're very global, so we invest in many countries. No real restriction on where we'll invest. We'll discuss what seed and Series A stage means a bit later. So what is venture capital? Some of you might have a better understanding than others over what VC is. But VC is a type of investing. So what we do is we basically trade money for ownership in companies. We take what's called a minority equity stake. So we don't buy companies outright. The founders keep control of their companies and continue to run them. We just buy a share in that company. The way that VCs then kind of return that money is they wait for founders to sell their companies or float on the public markets, IPO. This is what's called an exit, basically when the company's assets are liquidated and turned into cash. Now that typically happens in a kind of quite long time frame. Over 5 years is pretty standard for the VC industry. So it's really a long-term partnership between the VC fund and the company. I think important to note, VC funds don't get operationally involved in their companies. So we don't do things that a publisher does, like marketing or user acquisition, but we do provide advice and support. We'll talk a bit more about what that looks like a bit later, but it's anything from networking to sharing knowledge or helping them think through decisions. Cool. So I think the funding model most people in the games industry are most familiar with is publishing. So we're going to spend a few minutes talking about what the difference between publishing and venture capital is. It's important to know there are other funding models. So there's debt and grants that a lot of you are familiar with, but publishing and venture often kind of get confused. The first major difference is what the different funder is investing in. So venture capital funds invest in a company, whereas publishers will invest in particular projects or games. We care less about one particular game's performance and more about the ongoing performance of multiple games or kind of the company's general performance. In terms of timeline that companies work with their funders, VCs work in a very long time frame, as I mentioned, kind of 3 to 10 years, whereas publishers are really looking to get their money back in a few years' time. The return model we'll explain a bit more in a second. It's basically how they make money. That's the exit I mentioned earlier. The involvement I also discussed. VCs are advisory. We don't do things like marketing. And along with that, VCs ask for relatively little control, almost no control over the day-to-day operations of a company or the creativity that the company is creating, whereas publishers often will ask for creative control. And VCs are also looking for kind of high-risk, high-reward bets, whereas publishers want to get most of their money back on most projects. So VCs are willing to take pretty long shots. People say that kind of most VC-backed companies, venture capital companies, expect to fail. So they're very comfortable with high risk. So this is the equity return model that I mentioned. So what is equity? Equity basically just means ownership of an asset or a portion of ownership of an asset. In this case, this is shareholder equity. So you can think of founder equity here, the blue bar, as the portion of the company which the founder owns, and then the green one is the portion of the company that the VC fund owns. What the graph is showing here is the company's value over time, broken down by ownership. So this is what's sometimes called a cap table, short for capitalization table, and it just shows who owns what portion of the company. So important to note is as the company's valuation grows, so does the value of the equity in proportion to that value. Companies, there's kind of two ways to think about company value in the context of VC funding. The first is pre-money and the second is post-money. You might have heard those terms. They're not hugely complicated. It basically just means if I'm raising money, at what point do I state the valuation? So to use the example here, on the left-hand side, we have a company that is worth $10 million post-money. The reason that's post-money is because the founder's equity is worth $8 million and they raise a $2 million round. So then it's $10 million post the VC's money going in. 5 years later on, this company has grown. They're in a slightly different stage, right? They were pre-revenue in production. Now they're probably profitable. They have multiple products perhaps, and they sell for $100 million. Now, assuming the company didn't raise any more money in that time, what would have happened here is both the founders and the VC's equity will have grown in proportion to the company value. So if I'm a VC and I invest $2 million at a $10 million valuation now, and then in 5 years' time the company sells, I get $20 million back. It's a 10x return, which is pretty good. So that's kind of the overall introduction to the equity funding model. It's not hugely complicated if you're familiar with it. This is quite important to understand how VCs return their capital in a company sale, because it really impacts the type of company they look for and the type of industries they work in. So now, why do companies raise venture capital, especially as regards to some of the other funding models? Well, I think that VC has a number of advantages. It leaves you with considerable control, and it also has kind of less onerous obligations than something like debt. So if you're looking to raise money, there are a few reasons that you might choose a VC. A lot of people think of the money-related reasons. So if you look at the first four here, pre-revenue or early stage funding. If you're trying to create your first game and you don't have any revenue, you need money to make that game. If you want to hasten development up and scale up faster, that's another reason. There could also be capabilities you want to bring in-house. This is something we see a lot with a mobile studio that maybe has had a few successful games and they want to start self-publishing or doing their own UA. And then kind of another money-related reason is if you want to expand your product lineup, start a parallel production track. But there are other reasons people don't think of as much, the benefits that the VCs provide. So for example, you gain access to the VC's network, which is probably pretty large, especially if, like us, they're industry specific. So we spend our whole lives working in the games industry. So a lot of our job, in fact, is providing advice and support and also introductions to our portfolio companies. Some examples of this are we have helped portfolio companies launch in sometimes tough to reach markets like China, help them hire, introduce them to platform holders like Google. And then the final reason is being venture backed, it's a term you might hear, is a real validation. It can be kind of a boost of confidence on the market. So for B2B companies, that can help you with sales if you say a VC is backing you. And for any other company, it can help with hiring. I'll now hand it over to Michael to talk a bit more about the process of raising venture capital.
Sure. So I think two really important parts of the process now. So now you kind of understand, okay, this is kind of how VC works. This is what equity is, and this is really what a fund's objective is. The next stage is, obviously, how do I decide who to talk to? I mean, there seem to be an endless number of quote unquote venture capital funds. How on earth do I know who is relevant for me? So, if we think about the four things that you really want to ask, and I would also frame these as questions that you would want to ask yourself and also ask the VC investor as well when you speak to them. So the first question is, what is the investment stage that they focus on or you focus on? So this is really asking, hey, look, are you investing in companies that are pre-product, you haven't launched anything, I've just left my job at EA and I want to start a company. Here is my idea for a game and I have two other friends that I want to start with. This is called a seed stage company or a pre-seed company. You really want to understand, does the fund invest in early stage and seed companies? Or are they a fund that really focuses on what we call Series A or even growth companies? And this can typically mean things or stage where they've actually already made a product. Maybe you have a prototype, or maybe your game is out or your product is out and you actually have user metrics. So you really want to understand, are they later stage or they earlier stage? The second question you really want to ask them as well is, what do you actually focus on? And for us, I think it's quite clear. I mean, most people here, I imagine, are involved in the games industry in one way or another. So it's probably one of the first questions you want to ask is, have you invested in the games company? Do you focus on it? Is it in one of other areas? And this is also because this grounds you for understanding how much do they know? Do you really need to explain how streaming and how that can influence buying decisions for games works, or do you need to really explain from square one? So this is another thing I think is extremely critical, and that's to kind of prioritize your time and where you focus the conversation. Third question, geographic focus. This one is also somewhat intuitive. Obviously, if you're based in, say, Finland, and you're talking to a investor based in the US, you want to understand, have you ever invested in a company in Europe or in the Nordics before? Or alternatively, maybe you're based in Canada and you're talking to someone in Europe. Have they done it before? Because it's not always a given that they are willing to do this or they have the risk tolerance to do this. And then finally, and slightly more nuanced, is just fund strategy. Generally speaking, if you're talking to a venture capital fund, they will be wanting to invest in you for the long run, right? And as Archie mentioned, it's 3 to 10 year time horizon. But it's always good to ask that question. Hey, what do you really look for when you invest in, what's your time horizon? And really just validate that they're looking for a long-term relationship here, not just a 1 to 2 year quick turnaround. And so now you've figured out, okay, here are the kind of objective reasons why I should speak to these people, or maybe why I should prioritize certain funds. Now you're left with a short list of maybe 10 or 12. How do you actually choose between them, or what are the criteria, assuming that there are multiple that you like? So this is where you really want to understand the people and the history and reputation of the firm. And so if you think about when you're also picking a partner that you work with or an employee, you also want to understand, okay, what's their reputation? What have they done in the past? What outcomes have they achieved, and what have they actually helped with? And equally, as you would call an employee references to find out how they were, you would want to call a VC's past and historic investments and portfolio founders to understand, hey, what was it like working with Michael? What did he help you with? Hey, in times of need, was Archie there to help you? And that's something that honestly a lot of investors are used to, and you shouldn't. You can do it two ways before you or when you choose to work with someone. You can either directly ask them for references, or you just cold reach out to people that you see online that they've invested in or worked with. So this is one way you can validate who you work with and who you choose to work with. I think another major one is thinking about the cultural fit. So what is the background of the people you're working with, the VC you're working with? Can you relate? Do they seem to be able to empathize? Do they understand? And really, do they know how a game studio works? And this is really something you get a feel for after talking to them, and after 3, 4, 5 conversations, you get a good sense of this. But it's good to keep in the back of your mind. And the common anecdote for working with VCs and investors is it's like a long-term marriage, right? It's not quite like a publisher where, hey, look, you publish a game and you sign the contract, you've done it, you've shaken hands, your rev share deal is there, and maybe you have some ongoing IP obligations, but that's pretty much it. With investors, they're almost like they are partners actually in your business. So you want people that through the tough conversations as well as the good, you trust that they'll act in your best interests. Okay, next page, please. Okay, so I'll go through this one a little bit quickly as well. We have 10 minutes. So we also wanted to explain what is the process of going start to beginning of getting investment, right? So, okay, finding the right VCs and preparing your materials. These two kind of come hand in hand. What a VC will be expecting when you speak to them is you would have some kind of presentation that roughly goes over what are you trying to do, what's your vision, who are you, what are your team's backgrounds, what have you done in the past, if you have any kind of metrics or KPIs, what they look like to show traction on what you're doing, and then financials, right? Like what are you looking for, how much money you're looking to raise. this is obviously something that you should polish in advance. Alongside that, you should also think about who you want to talk to. Research a list, Google, go online, go on Crunchbase, go on GameIndustry.biz, look at VentureBeat, GamesBeat, who has funded games companies in the past, and who therefore is on your list. Ask your friends who've received funding. So now you're at the stage where you've got your materials ready, you know who you want to talk to, and you have to go through the pitches. So you get in contact with these investors, and the question is, how do you do that? There are multiple ways. The best way always is an introduction. So if you happen to be in a fortunate position where you have friends of friends, or you can go on LinkedIn, look up the name of the fund, see what mutual contacts you have on there, and reach out to them and ask if they wouldn't mind introducing you, right? But if you don't have that, a cold email, or go on their website. Often they have email addresses. Go to events like this. Most of the time they are relatively contactable through these public forums. So you reach out to them, set up a meeting, and you do your pitch. And what will happen is you'll go through multiple calls. They'll ask you questions about what you think about your vision, why you're doing this, why you're doing that, how you think about different things, why you need this much money. Eventually, you go through this process, and maybe your 10 conversations will end up with 2 or even 1. And hopefully, you'll be offered what's called a term sheet. And a term sheet essentially is a non-binding legal document that says, I, Makers Fund, intend to give you, company A, a $3 million check in exchange for 20% of your company. And what would then happen is you may or may not have some very brief negotiations around what's acceptable, what's not acceptable, and then you'll kick off what's called legal due diligence. And that is basically when you have your lawyers look through, and they will basically just say, okay, is founder A who they say they are? Is the company really real? Is it incorporated here? So it's mainly legal checks that everything really exists, and it's pretty much a standardized procedure. And at the end of it, you've signed, and they'll wire you the money. This whole process typically takes between 4 to 6 months. So that should give you a good timeline on how long you want to plan for. I've seen it happen in 2 or 3, particularly the earlier stage you are, the less, for example, due diligence in terms of legals there are, because the company didn't exist 3 months ago. So, but the fastest I've seen is about 3 months, and the slowest I've seen is 6 or 7 months. Okay, and then the last slide. Right, okay, and then last but not least, what are they looking for? So 2 main factors. You have the company factors and the market factors. I'll start with the market factors first. So really, when a VC invests, their financial objective is to obviously generate returns, but it also they have a focus within the games industry normally in certain subgenres or certain subsectors. And what they really care about is that it's a large and growing market, right? So, not every genre market is created equal within the gaming industry. So, for example, we all know that just as an example, the match 3 industry, so like Candy Crush, Garden Skates, that is a $1 billion genre, whereas the single player adventure story-driven narrative game maybe would be a fraction of the match 3 size of the industry. So what the VC really will care about is how large is the market, and that's because they really want to understand what's the opportunity here, right? And that links to the second question, which is how clear are the exit opportunities? So the opportunities in order for the not just the company but also the investor to essentially exit together with the founder, right? So this could either mean acquisition by a larger company, or sale of the shares, or a IPO, right, of the company on some kind of stock exchange. So that's also where the revenue and the market size is quite important. And then the third one, the scalable revenue potential. This one is more around, is there an opportunity where you can exponentially increase the revenue of your game, right? So games that are typically driven by DLC are a lot harder to scale the revenue because you have to keep churning out the content. So that means normally your business model has to reflect that early on, versus a game where perhaps you have a kind of a games as a service type free-to-play model. You have a long, very, very loyal, high monetizing player base over a very long period of time, multiple years, like Warframe, right? And then just very briefly on the company factors. the types of questions you can expect are questions like, what is the team's relevance and background to the project or the game they have in mind, right? Have they worked, if they're planning to build a game-changing sandbox MMO, what are the MMOs or the sandbox titles you worked on in the past? And if you worked at Mojang, or if you worked at Linden Labs, maybe that would be excellent experience in order for you to really understand the nuances and intricacies of player experience and game design for this type of experience. And this kind of somewhat leads into the second thing, which is, what is your edge? So equally, if you are building an MMO, as we all know, that is a very, very crowded space. So what makes your MMO, your game, or your experience different? Is it that you're going to be playable on any device, or maybe you're targeting a certain subsegment of users that is underserved? And finally, of course, I think VCs typically want their founders to own the company they're working with. So if there is existing history of some kind of investors, they want to make sure that the cap table, or the capitalization table that Archie alluded to earlier, is relatively clean and ideally majority owned by the founders themselves. So yeah, that's a very brief overview of the types of things that VCs would look for. Hopefully that was clear, and we did intend to make this quite simple, and hopefully that was the kind of level that people found interesting.
So I'll quickly say this was an amazing presentation and so useful. And when we invite you back next year, I think we need to give you a little more time, a little bigger platform, and maybe bring you on earlier in the festival, because I think this is really a great starting point for a lot of these conversations. So unfortunately, we only have a few minutes now for questions. The first one is, can people access these slides somewhere?
Archie?
I guess so. I haven't put them up anywhere, but I could probably share a PDF with anyone who's interested.
Okay, so if everybody wants
shoot me an email.
Your email again is pinned at the top of the chat there. I'll ask you quick questions, because and I don't, can you guys hang a little bit after the session, like 5 minutes after?
Yeah. Okay.
So this is the Games for Change Festival. So clearly the games part is covered here. What about the for change part of it? Are any of your current investments really looking at social benefit, social good? And how is that a factor at all in your investing strategy?
I can take this one, Michael, if that's okay. So I think that it's important to know that VCs themselves have investors. So our money comes from other people. So that can be big companies, high net worth individuals, but it's often things like pension funds. And so, our primary purpose often is to look at the financials of an investment. But that definitely doesn't mean that social good ESG stuff is ignored. It definitely isn't. And in fact, I think that there is a very good investment thesis around games for change as a growth category. So if you look at something like documentaries, which could be analogous, right? There really wasn't a documentary. There wasn't really a great way to make money from documentaries 10 years ago, whereas now it's actually quite a profitable and growing industry because Netflix kind of really changed the value of a documentary. So I think that there could be a similar thing, and consumer tastes have warmed to kind of more social impact focused games. So I think that could be like a very strong investment thesis that, we have a lot more social awareness now. It's factored into consumers' buying choices a lot more, that actually games for change are a growth category. And then, of course, our investors and us, we definitely consider social impact in an investment, even if it's not often, the determinant criteria. There are funds, impact investment funds, for whom that is one of, if not the primary criteria they judge their investments by. Michael, do you have anything to add there?
Nope. Good answer.
Okay, so I'm going to just try and aggregate some of these questions that have come in. So what stage do you invest in? You did talk about seed versus Series A. What kind of proof of concept do you look for? And, can you give a couple of examples from your portfolio that sort of demonstrate that?
Michael, you want to take this one?
Sure. Yeah. So we have invested in anything from someone coming up with a plan on a piece of paper saying, hey, this is what I want to do. Here is my team, and this is why I want to do it, right? This is obviously very unique, and we've done this normally when the team and the plan is so in sync that it's kind of a no-brainer for us. We don't really need to think too much about it. It's more about whether you believe the team or not. Equally, we've also invested in quite large rounds of, say, 10 million or so, $10 million in rather late stage companies that are already out making money and around for 7 to 8 years. So we're quite broad, and so we typically say we invest in anything from $1 to $10 million. In terms of the examples of companies, so without knowing where everyone is in the audience, companies like TinyBuild, over in the US, Bossa Studios over in London. I've also invested in companies like Parsec, which is a technology company, Metal.tv, a VR Chat, which is like a platform that became very popular off of a meme. And so we're broad. We don't just do studios. We're also investors in technology companies and platform companies.
Great.
And sorry, one last question I think you asked, Kevin, which is, do you need a prototype? I think was the
proof
question,
of concept,
right?
yeah, something.
Proof of concept, yes. So I think if you ever have the means to create a proof of concept or have a product or a prototype or anything, it will always benefit you. Not having it, I think, is fine depending on what you want to do. But if you ever can prove, the more you can prove, the better. And I think if you can even get market data. So often now some products, you can put them out in market early, get early user feedback, even just do soft launching of your game if you've got a game. So we're in a place now where it's relatively easy to get early conviction from the market.
All right, and let's take one more question, then we'll close up. This is from Claudio. We're a startup of game user research and QA. Makers Fund invest only in games or invest in the ecosystem too? So I guess as I understand it, so do you invest in, I guess, either services or sort of ancillary work around games, if not a specific game product, perhaps?
I'll take this one. Yes, we absolutely do. I think actually, if you look at the history of games, some of the most exciting things to have come out of games are the technologies, the business model innovations, the practices that originate in games, but then have found use cases and applications outside of games. I mean, things like the audio chip in computers was invented for games. Graphics cards, obviously, come from games really, and now have huge purposes in Bitcoin. You look at a company like NVIDIA, which was a games company to some extent for most of its beginning, and now makes healthcare technology. We're absolutely interested in those parts of the games ecosystem.
What about specifically research, I guess? Do you invest in that?
There's nothing we would say kind of off the bat without looking at the opportunity do we not invest in if it touches games. We actually have had a research-related portfolio company, a company called Superdata. So yes, I mean, in theory we do, although obviously, we need to dig much deeper into the specific market before making an investment decision.
Okay, and we'll just grab one last quick question. If you don't mind sharing, how big is your current fund? How much do you have remaining for new investments? Do you reserve funds for follow-on investment rounds?
Michael, you want to take this one?
Yeah, so we actually have two funds. So our first fund was just shy of $200 million, and we invested in about 45 companies, and we started that in 2017. And then in 2019, November, we actually started our second fund. So we're still in the first year. This one is it's still open, but it's right now around 220. So total we're at 400-ish. And how much we have remaining for new investments? Almost like a lot. So most of that 220 is still there. And yes, we do reserve for follow-on. I think one thing that's very important to us, and you will see it in our first fund investments too, and who we've worked with, which is when we invest in founders early, we don't do it very often when we go very, very early, but when we do, we invest in the life cycle and the lifetime of the company, right? So as long as we have the means to, we'll back, the following rounds, we'll help everything we can. We have many companies where we've invested, 2, 3, 4 times thereafter, to make sure that they really have what they need to succeed.
And in your slide, you had that 10x return on $100 million, scaling up to $100 million enterprise. Is that ballpark what you're shooting for? Is that a benchmark, or is that just an example?
So I think broadly, yes, a lot of people would say that's what VCs expect from their companies, but I'd maybe phrase it slightly differently, because as I said earlier, VCs expect most of their companies to fail. We take big risks, so we expect a lot of them to just not make it, which means that the ones that do need to do really well. Which is why we target companies that have really big potential exits. It's because we have to bake that into our calculation. It's hard to say is 10x exactly what we're targeting. It varies by stage, specific for the company. But yeah, I think it's a pretty reasonable kind of target for potential exit.
Ballpark. Great. Well, listen, thank you so much. This was incredibly instructive for me, I got to say, and I really do hope we can have you back next year and really make this maybe a little more, give you a little bit of more of a platform to share this information, because I think it's really great.
Thank you. And thanks for all the nice comments, everyone.
Yeah. All right. Take care, everybody. And thanks again, you guys.